There's a lot of news with Intel, and it's been 6 months since we last took a look. So it's time to look at this stock again and see what's going on. Nvidia drove markets higher this last week and growing their revenues at an extreme rate because of AI and how their GPUs and data centers can be used in artificial intelligence. Those chips are all made by Taiwan Semiconductor, and they're booked out for years. So there's not a whole lot of room for anyone to compete against Nvidia, but there are ways to compete against Taiwan Semiconductor. One of which ways could be Intel. If Taiwan cannot handle the capacities, Intel is building a lot of factories, and they might be able to help Nvidia on creating custom chips. Right now, they just did a partnership with Microsoft the other day where they're going to manufacture the chips for Microsoft, and the CEO said that he wants to manufacture every single AI chip in the industry. So just him saying that is probably going to be pretty bullish for the stock. We also see they tried to merge with Tower Semiconductor in China. China blocked that. They're building 2 new CPU fabrication facilities in Arizona and another one in the EU. So there's a lot going on here. They've been in kind of a rebuild for the last few years now, and the stock hasn't fared too well. We can go straight to the chart here, and you can see that the share price in blue here has been kind of up and down. Last year was a decent year for them. We see in 2020 they were around $50. Now they're currently around $43. They did hit the 20s in 2022 and ended out last year at $50. So they are down about $10 on the year. The last time we looked at the stock, they were $36. So you would have made, if you were still holding, about $1 a month plus dividends. Their fair value grew from 28.21 last time we looked at them. Now it's 38.27. So they have seen a lot of growth. Part of that is they did come through with higher revenues than expected. They were expected this last year to come through at 52.4, and they came out at 54.2. Looking at our summary page here, cash flows, they've been up and down. It's mostly due to all the investment in the new facilities that they're doing. We can give them a pass on the falling cash flows, and hopefully they'll come back even higher once they do start producing from those facilities. Dividend, they cut their dividend. That was a huge factor in why the stock price dropped. Still, right now, how they came through last year, they can't afford what they're paying. So that is something to keep an eye on. Honestly, they should have just cut it away altogether and focused on building the company. They're not doing shareholders much of a favor by going negative, paying out more than they actually make. These returns do not look good now. Last time the ROE was 7.9. Now it's down to 1.6 over the last 12 months. ROI is up a bit though. It was 4.11. Now it's 6.7. So they're making more off their investments. Their equity, not so great. And they didn't even have an ROA last time. Well, we didn't even calculate ROA 6 months ago. Now we see that it's not even 1%. Hopefully they can fetch double digits after everything is said and done here. Debt to equity does look pretty good, 0.74. I mean, the lower the better. As long as it's below 1, we like it. Margins, down from what they could be. They definitely have some growth that they could use, but with all the investment, we can give them a pass on it. So the question for the stock really becomes, when do you think the investment's going to be done, and what do you think it's going to do for the stock? Because analysts are projecting growth 2 years out, 4% compound annual growth rate. So they're still looking at that investment this year, and then next year you'd be looking at around a 6% for that year. Ideally, they'd be ramping it up past that, and we'd be hitting returns higher in the future. I mean, if we look historically, 2020 and 2021, there's 1% growth, and then they've been on the decline for the most part since then. Looks like a 7% jump. The expectation last year was about the same as this year's. So they could beat it, come through flat, come in with growth, compounding over the next 2 years. I want to give it almost a 6% here just to mess with the numbers, but we'll run through everything and then we'll adjust. Earnings per share, I mean, they were very low this last year. They should be a lot better going forward. This year, they're expecting somewhere in the realm of 125 and then 207 the next year. I mean, they were about $5 back in 2020, 2021. Share count, they are issuing shares. I know we don't like that, but if they're using the money to finance operations, building new facilities that are going to have a decent ROA, it could be beneficial to shareholders. I mean, I really wish that they would just get rid of the dividend instead of issuing new shares, because then they're paying out even more money. But I'm not managing the company. Assets, they've been growing them. Slowed down a little bit. Well, yeah, slowed down a little bit over the last 2 years. Going forward, if we can get somewhere in the realm of 5 to 6%, that would be good, especially with all of the facilities that they're building. Liabilities have been flowing down, or have been holding pretty steady around 4%, so we'll stick with that. Dividend growth, let's assume it stays flat. And then margins, they're quite a bit off of what they've done previously. So we're going to say that they're going to get up to their margins a bit faster. I mean, at this 5% rate, you'd be looking in 5 years of them being at a rate of 4%. So that's not even anything crazy. We could probably factor in some more growth in that. Here, get them up to 5%, 10% a year. And so with this thesis, we're looking at 4.2% year-over-year returns, growth in the fair value, that is. So if you were to buy at today's price, you'd be looking at a fair value on your shares $2 lower than you're buying, and all of your profit is going to be coming from the dividends that are getting paid. So you're getting 1% in dividends and losing fair value. And then over the course of 5 years, you'd be looking at a almost $2 gain on your position. And again, almost all your growth coming from dividends, 13% returns there. So you're definitely underperforming the market in this scenario. So we'd want to factor more growth in. I get most of the time stocks trade at future multiples, and we're just trying to find stocks that are currently trading at a fair value, a good value where you can get in and expect a 2 to 3x returns, as Peter Lynch would always look for, the double and triple bag. So assuming that they're able to grow this 4% faster, I mean, if we can take this up to 5, well, we can see that 4.2 per year grows to 4.6. Now you're still underwater on your, or under market returns. If they can grow it to 6%, almost 5% returns, still not in line with the market. So even a double-digit return would underperform the market severely. You'd be looking at 6.6% year over year. If they can get their margins up faster, that would definitely help things. So if they can take them to 6.26 over the course of the next 5 years, then you'd be looking at 5.6%, still underperforming. So we're trying to find a scenario where they'll perform at a minimum in line with the markets. So it looks like if the only thing that we adjust is through revenues, a 17% compound annual growth rate over the course of the next 5 years would get you returns in line with the market, and that is factoring in a dividend being paid. I mean, at that rate, they should be able to reinstate their dividend. You'd probably get it faster, but buying at today's prices, you'd really want to see 17% year over year growth in revenues and everything else coming in on average. If we can adjust the margins a bit, 3-year returns in line with the market, then we'd be looking at something more like 24% revenue growth year over year. which would put you far ahead if they can hold that for 5 years. And that's 14% annual returns. Do we think that this is possible? I am looking at the history of the stock. I don't really see that happening. I mean, they might be able to get back to 2021 levels, beat it a little bit. So that's about 30% there that they are underneath their 2021 levels. But in 3 years, they'd be doing $100 million in revenue with that 24% compound annual growth rate. I really don't see that happening. I mean, we can adjust it to get to 80 in 5 years. I think that's much more reasonable. It looks like that would be about 9% revenue growth would give us that. It'd come in at 83 in 5 years, which is a bit higher than they came through in 2021. And then we'd see where it would go from there. So the story here is we see some catalysts. We'd be looking for at least double-digit returns, and a lower share price to get in is really the ideal here. I mean, if you can get in at 38 approximately and get returns of around 12% per year over the course of the next 5 years, and that would be the ideal scenario here. And so that may involve another year of waiting to see how all of these facilities work, how this new Microsoft deal pays off, and how they get into building these AI chips. But for now, I don't know. The stock price seems a little hefty for what's expected of them. So I want to thank you guys for watching. Please like and enjoy the video. Comment what other stocks we should take a look at, and subscribe so you can stay up to date with everything. And I'll catch you next time.